From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro with an optimistic green tone ahead of the Open. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
We begin with the big issue, recession calls gaining momentum.
Risks are clearly growing.
It could be a pretty significant slowdown.
Becoming increasingly amplified.
Basically, will be one of a recession by the end of this year.
A recession is somewhat inevitable.
More than likely,
risks that we move into recession are going to be increasing.
More pain to come in broader markets.
Wherever we look in terms of our indicators, they all look pretty recessionary for the next sort of 3 to 6 months.
Everybody's waiting for the recession.
It's a simple debate. It's hard to figure it out. Is when does the recession start?
Where are we on the risk of the hard landing?
How hard of a landing can the Fed and policy change really create?
The Fed has no choice. Keep on tightening, even if that's going to lead to a hard landing.
I'd know when to ditch the dog. I daren't ditch it now.
The chief concern for the market for sure is that central banks will tighten their economies into recession.
After listening to that, you might want to crawl back into bed. However, we do see futures up and a little bit more optimism baked into some of the notes that I was reading over the weekend. Joining us now to discuss Eagle Asset Management's James Camp and Julie Biel of Kayne, Anderson, Rudnick. Julie, I want to start with you. Have we baked in already the prospect of a recession, and is that why we're seeing perhaps hints of optimism now?
No, I think we still have quite a ways to go in terms of movements towards the recession. And that's quite simply because we don't know the depth or the severity of what may be coming towards us, right? It's hard to know exactly where the consumer is going to end up because that's really the economic engine for the U.S. economy. And, you know, the consumer has really taken it on the chin the last probably, half year. And I think trying to understand how much resilience the consumer is going to have and how much job increases and wage growth is going to maintain is key to understanding the depth and the breadth of the recession.
So Goldman now seeing a 30% probability of recession over the next year, at least in the United States, with Jan Hatzius writing, quote, "We now see recession risk as higher and more front-loaded. We are increasingly concerned the Fed will feel compelled to respond forcefully to high headline inflation and consumer inflation expectations if energy prices rise further. Even if activity slows sharply." James, do you agree that there is enough conviction within the Federal Reserve to pull a Volcker, to go even if they see the inflation data perhaps coming down, but in tandem with the unemployment rate going up?
Lisa, I think so. I think the Federal Reserve has been caught dramatically off guard or off sides, if you will, in terms of policy response, at least in terms of timing. This has bled into the political issue. As we know, inflation is the largest regressive tax you can layer onto an economy. And all the signs point to the Fed being much more active and really slowing and tightening credit conditions in aggregate, even more so than just moving short-term interest rates. We're seeing a lack of bond deals coming to markets. We're seeing IPO add-ons or equity add-ons not coming to market. This is a capital market slowdown of consequence, and it is a complete recasting of the fight that we have not seen for multiple decades. And the Fed has to be aggressive and destroy demand, which brings you to your recession question.
James, do you agree with Julie that it's not been baked into valuations yet?
No, I don't think so. I think we have room to fall in risk assets, and that's the unfortunate consequence of this. Part of the conversation, though, is this deleveraging effect that inevitably follows massive monetary easing. And we see it across asset classes. When you see year to date really nothing working, that is a sign that we're having sort of a deleveraging moment in capital markets, which will play itself out, but it's going to take some time. So credit conditions are getting very, very tight, and risk assets are going to be under significant pressure for the next couple of quarters.
And underpinning this kind of call is what former Treasury Secretary Larry Summers said over the weekend, or actually yesterday, talking about what could curb inflation, saying, quote, "We need 5 years of unemployment above 5% to contain inflation. In other words, we need 2 years of 7.5% or 5 years of 6% or 1 year of 10% unemployment." The numbers are remarkably discouraging relative to the Fed's view. Let's bring in Bloomberg's Michael McKee for more. Mike, we've been talking about this, with some calling the Fed's projections fantasy land. How realistic is what Larry Summers is saying?
Well, it's Larry's calculation of what it would take. He's obviously not advocating that millions of people be thrown out of work, but if you're the Fed and want to get inflation under control, he thinks it's going to have to be something like that. Although he told President Biden yesterday that he didn't think we needed necessarily to have a recession. And we don't have one right now, at least according to the NBER indicators. They are, of course, the arbiter of recessions. And you look at the incomes, employment, consumer spending, they're all still at least on path, if not still rising. And therefore, we don't think we're in recession now. The guess is that you don't really know when you're in recession until after the fact. And these people, you mentioned Goldman earlier, are already calling for a recession or saying a recession is very likely given the situation that we are in right now and the fact that the Fed is going to have to be aggressive. So later this week, what are we watching? We're watching some indicators that may give us some information. And of course, we are watching Jay Powell. He is testifying up on Capitol Hill to the House and the Senate, and he'll be offering his view on how aggressive they need to be. But look at existing home sales today. And then, of course, on Thursday, jobless claims, they'll be the canary in the coal mine for employment. And then the Michigan numbers, we don't focus on this a lot, but the Fed did the last time they came out because inflation expectations jumped. And that, Jay Powell said, led them to the 75 basis point move. We'll watch and see if that changes at all in the latest iteration of the numbers, Lisa.
Michael McKee, thank you so much. We still have James Camp and Julie Biel with us. And Julie, you were talking about how you do not think that it is priced into the market that we're going to face off with some recession. Are you actively shorting certain stocks, since I do know you run long-short strategies, or are you just refraining from buying?
Well, typically when we short stocks, we are taking a long-term view on something that's in kind of a secular downshift. So a good example of that would be something like office supplies. But, in the near term, we do see a real opportunity on the retail side, because if you think about what's on a boat right now in Long Beach, it was something that was ordered some 6-9 months ago when oil was a very different story. And so I think we're going to see a real tsunami of inventory hitting our shores, and that's going to really kill the back to school and holiday season. So retailers are definitely a place we would be avoiding, even though they've really taken it on the chin. I think we don't know what the earnings bottom is for that sector and how they're going to recover.
Julie, we were speaking with BlackRock's Russ Kostrich earlier this morning, and he said that the best hedge against weakness in equities right now is long dollar. Is that your case as well, or is there something else that seems to be reliable, the sort of conservative play?
For us, we're always focused on quality businesses because we're trying not to do too much forecasting of how the U.S. economy is going to turn out, right? Who could have predicted COVID? Who could have predicted this war? But they're all having serious impacts on the economy. So for us, we try to find businesses that can just weather through these kinds of storms. And it's really important to think about fundamentals in terms of business models. The most resilient types of business models are things that have network effects. So like a Market Access is a great company that can be really well positioned, even if we have a serious downturn.
So meanwhile, we're looking, James, at a situation where some people are actually starting to go back into bonds. What's your view on that? I know that PIMCO, for example, this morning, Mark Seidner came out and said that bonds are actually suddenly attractive again.
I think absolutely. I think we're in a peaking process in the 10-year Treasury. We're now at least double the yield on the S&P. So for income investors, for our multi-asset class income strategies, we are leaning more into the bond market than we have over the last decade. We still like a lot of the dividend plays. We like a lot of the earnings. And as your prior guest mentioned, quality businesses, pricing power, all of those things. There is a change, I think, in terms of where investors are going. Value, income, proof of earnings, proof of free cash flow. But the bond market is looking to us to be a very attractive, certainly a much better entry point than it has been for the last couple of years. And just to remind our viewers, 0.40 basis points on the 10-year Treasury just a little over 2 years ago. So these 3.5% yields, actuarially speaking, in long term, you add on a corporate credit spread that has widened, you're getting 4.5-5% yield for an asset class that has been out of favor for a long time, and it's time to take a good hard look at that.
Although the counter argument to that, James, this is something that's the concerning point for a lot of people as if inflation takes off. St. Louis Fed President Jim Bullard was weighing in on the current inflation picture, saying, quote, inflation expectations could become unmoored unless the Fed takes credible action, and if we didn't do that, we could get a new regime that would look more more like the 1970s, then you'd have high inflation and volatile real economic performance. It is definitely not something that anyone wants to see. But James, how much is this a risk case for bonds as you go into them, especially given the fact that a lot of people question the Fed's resolve to really spur a recession?
Well, first and foremost, Lisa, I think that the Federal Reserve is on this. This is late, but they will be probably overly aggressive. I think secularly, demographically, and globally, we are still in a secular downtrend or moderation in interest rates. So I would disagree with the former Fed governor. The other part of this is if you have perfect foresight coming into 2022 and you knew inflation was going to spike, that was our base case, that we were going to have higher and more stubborn inflation, and you bought something like Treasury inflation protected securities, you were down in the worst market for tips in 20 years. So the point is you have to be very judicious in what you select, the names that you select, the asset allocation that you make, and to sort of be cuter by half and try to get in front of some of these trends with products that don't necessarily work probably is going to be counter to the investor's best interest. I think inflation secularly comes down in the next 18 months, but it's going to be a very difficult few quarters.
Julie, how much are bonds an offset to potential equity risk right now?
Well, I mean, I think we still have some ways to go in terms of the equity risk premium contraction. And I think for us, it's hard when you are facing this much inflation to be looking at, certain instruments that haven't really been working. So, as an equity investor, I'm always going to say buy equities. But I think, thinking about inflation and how it plays out, for us, we're more focused, obviously, on small and mid cap stocks. We think that domestically focused businesses are going to be better protected in what I think will be global recession.
We have more on that coming up. Julie Biel and James Camp, both of you are sticking with us right now. Let's take a look at the stocks moving ahead of the opening bell. Abigail Doolittle here with some details. Abby.
Well, Lisa, what a difference a long weekend makes, because we certainly do have a nice relief rally. And even with yields higher, we have big tech rallying. That means the likes of Apple and Nvidia, some of last week's biggest laggards, up sharply, up 1.6%. And UBS supporting Apple, saying that China iPhone checks look pretty positive there. The chips were hit really badly last week. A nice bounce back. Tesla up 3.3%. This is the company is even cutting salaried positions by 10%, reducing the workforce overall by 3.5%. You have to wonder whether or not this is the beginning of hearing of broader layoffs among companies. And then finally, Spirit Airlines popping once again, up 7.9%. This is JetBlue, really wants that Airbus fleet of planes. They've upped their bid by $2 to $33.50 per share, nearly $15 above Frontier. So even though Spirit, they have said that there are stronger synergies with Frontier, it's such a wide spread to that Frontier bid, it's hard to ignore, Lisa.
It's a fascinating story, Abby. Thank you so much. Coming up, the White House remaining laser focused on lowering prices for U.S. consumers.
President Biden wants to do anything he possibly can to help consumers. Gas prices have risen a great deal, and it's clearly burdening households. So he stands ready to work with Congress.
President Biden preparing for yet another meeting with big oil this week. That conversation coming up next. We are seeing momentum heading into the open. The S&P futures gaining 1.6% now, as we're just moments away, about 17 minutes away from the open. This is Bloomberg.
We are talking about price caps or a price exception that would enhance and strengthen recent and proposed energy restrictions by Europe, the United States, the UK, and others that would push down the price of Russian oil and depress Putin's revenues while allowing more oil supply to reach the global market.
The U.S. working with allies towards capping prices on Russian crude exports as President Biden nears a decision on suspending the U.S. gas tax. Take a listen.
That's what I'm considering. I hope I have a decision based on data I'm looking for by the end of the week.
Bloomberg's Anne-Marie Hordern joins us from D.C. for more. Anne-Marie, how realistic is this, considering some of the pushback and the criticism that it will actually increase the cost of prices by allowing demand to simply accelerate?
Right, because what you need right now in this market is demand destruction, and potentially this could increase that. Listen, Lisa, this is going to be very difficult because the administration, if they decide this is the route they want to go and they are trying to really pull any lever to bring down the cost of consumer prices, most notably gasoline, which is key to household budgets, they're going to have to get congressional approval on board. And we already heard from Senator Mitch McConnell back in February when this was floated that he said this would have too much of a hole in the infrastructure highway debt. That's where the money would come from. And he called it political games. Even individuals within the Democratic Party. We heard from former Secretary of Treasury Larry Summers just on Sunday talking to NBC saying he thinks it's a gimmick and that at some point you're going to have to reverse this. But when you have inflation this high and gasoline, the average right now is just a smidge under $5 a gallon, this is politically debilitating inflation. Right. And so the administration has every card on the table.
Anne-Marie, I know that you feel this way too. It's like Yogi Berra said, deja vu all over again in terms of the conversation that we've been having over the past few weeks. But has there been a shift in the administration's tone when it comes to how to handle the industry, fossil fuels, in terms of what their project is in legislative attention to inflation, talking about support for both the renewable and the fossil fuel industries?
Well, on one hand, we do know the administration is also working with Congress right now to try to bring back some of those provisions that were initially part of Build Back Better, and they're really re-signposting it as this is a way to fight inflation. Potentially some climate provisions could be part of that, because really the overarching theme of this administration is, yes, we need fossil fuels right now, but longer term, we want to move towards renewables and a more sustainable way to get from points A to B, right? Move our cars, heat our homes. But Lisa, you bring up a good point, because there has been a shift in tone in the sense the president wrote this letter asking the oil industry to do more, asking for more refining capacity. And then this week, we have Secretary of Energy Granholm. She'll be sitting down with those executives. So I would say stay tuned to what comes out of that meeting and whether or not the industry potentially wants to come help this administration out.
Bloomberg's Anne-Marie Herdern from Washington, D.C. Thank you so much. Standard Charter's Bill Winters, seeing an oil shock, and he warns that prices could still go higher. Take a listen.
I'm not a oil price forecaster, but could it go higher on the back of either further restrictions, further embargoes, or ongoing underinvestment? Yes, it definitely could. The markets will equilibrate over a period of time at a price probably a bit lower than where we are right now, because this is a demand-destroying price over a period of time. In the short term, though, we're very vulnerable.
James Camp and Julie Biel still with us. There's an issue, Julie, about whether all of this potential increase has already been baked into the price of some of the oil majors. Do you think that that's the case, that it's sort of overvalued at this point, or that there's more upside as we do see the pressure mount?
I think it depends if you're talking to a long-term or short-term investor in terms of how well positioned they are for the next 5 or 10 years, in terms of do they finally start to boost their capex and take advantage of this declining resource, or are they going to continue to be positioned to just maximizing profitability in the short term? Because the thing that we don't know about for all of these oil companies is what the price is going to be, and what the long-term impacts are going to be of a protracted war. Is this going to change the power mix, the energy mix for Europe? These are all really big questions, and I think it's, if you think of the fundamentals of these oil and gas companies, when you are completely beholden to price to drive the economics of your business, it's very hard to plan. That's why we typically don't invest in this sector.
James, what about you? Do you think that it's the inflation hedge, as many people have pointed to over the past 6 months?
Well, I think Julie hit the nail on the head with energy. It's a very hard business to plan. It's very hard to plan around a commodity price that's volatile. I think it's going to stay elevated for a long period of time, however, given some of the political decisions that have been made on permitting, refineries, and the like, and obviously the war. As an inflation hedge, frankly, I think when you look at consumption, if the companies and the things that you buy, if you find the best quality in those sectors and you participate, for example, some of the foodstuff type companies, if you buy their equity with a growing and compounding dividend, if you look historically, you outpace the purchasing power degradation of inflation by simply owning good shares of companies that participate. They're much more easy industries to forecast price and price elasticity than energy. But I do think the energy overhang, the albatross, if you will, is going to be with us for a while. And I don't see a lot of relief. And certainly the political sort of tinkering, if you will, or sound bites are not going to move the needle in terms of getting energy back online domestically. There's some serious questions and some serious policy decisions that have to be made if we really want to go back towards more of an energy independence idea with fossil, and we're not close to that right now.
James, how much of a support is this to credit in a way? Because if you look on the riskier spheres of the spectrum, a great proportion is tied to energy companies, which are being supported by where prices are right now.
Well, I think there's many good areas in the energy patch to invest, either in the debt or the equity. You have to be judicious and careful about where you go. Obviously, you don't want companies that are singularly levered to the price of a barrel. But right now, I think there's better opportunities in energy than there have been in a while. They've been a good performer year to date. We're certainly not massively overweight. But as we see this regime change, and that's exactly what it is, and commodities generally across the board higher, it's a fair place to look, at least for the next handful of quarters.
Julie, just really quickly here, I'm wondering if you see the potential going forward for other sectors to get hit harder than people expect because of where gas prices are right now.
You know, I think to me, retail, it continues to be the space. And then I think as we pass through the summer season, we're going to see a softening in the leisure space. You know, I think we're all going to have a great summer. We're all going to go on the trips we've been wanting to go on for 2 to 3 years. But looking forward, I still think that, you know, demand across retail, leisure is going to be quite soft, because I just don't think the consumer really has the power to sustain us over many years.
Our sincere thanks to James Camp. Julie Biel is sticking with us. Coming up, the morning calls, and later Lennar providing some relief for beaten down home builders. Invesco's Kevin Holt joining us with his outlook for housing. With earnings season underway, that conversation still ahead. We are seeing a sustained lift, actually gaining a little bit into the open and trying to rebound after some of the catastrophic losses that we saw in specific names last week and in the past 6 months. From New York, this is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Credit Suisse upgrading ExxonMobil to outperform, expecting the company's growth strategy to deliver excellent returns. Next up, UBS upgrading Charles Schwab to buy, highlighting the stock's enticing, attractive valuation. And finally, Cowen downgrading Under Armour to market perform, cutting their price target to a street low of $10 amid lingering macroeconomic uncertainties. Coming up, Invesco's Kevin Holt joins us for the opening bell. From New York, this is Bloomberg. Countdown to the open. I'm Lisa Abramowicz in for Jonathan Farrow. Moments away from the start of trading, and we do see gains across the board, maintaining a 1.6% gain pretty much in the NASDAQ and the S&P. But you can really see the strength in the dollar as where the strength and the momentum really lies. You're seeing yields a bit higher, but really the dollar strength pervading throughout the entire complex, whether it is Japanese yen or whether it's the Aussie dollar. You are seeing a euro with a little bit of strength, but what I'm looking at right now is the yen breaking down to the weakest level going back to 1998 as we look at that policy divergence, really getting called into question with some of the traders pushing back against that and saying, okay, if you're really going to commit to this, we'll double down as well and basically sell as much as we possibly can. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle. Abby.
Hey, Lisa. Well, we do certainly have a strong tone for stocks this morning after a brutal week, actually 3 weeks for stocks. But here we have lots of stocks higher. And one of the top story stocks on the day, Kellogg, up 5%. This as the company is breaking into 3 publicly traded companies. The largest will be Global Snacking, followed by North American Cereal. And then PlantCo, really following a recent trend of big conglomerates going smaller. Certainly good for the investment bankers, too. Speaking of investment banks, J.P. Morgan, now these shares had been down sharply last week, nearly up 3% today. This, of course, ahead of the Fed stress test. They are expected to be the largest returner of capital to investors, roughly $18.9 billion in buybacks and dividends if all goes well. Carnival bouncing back. The travel trade has been under severe pressure, but today we have some investors dipping a toe in. And then finally, with the rebound that we're seeing in Bitcoin, technically confirmed to go above $30,000 per Bitcoin, we have Coinbase Global in a nice rally, up more than 7% on the morning, Lisa.
Abigail, thank you. you so much. The Nasdaq resuming its bounce back after falling more than 6% last week on the Fed's 75 basis point rate hike. Joining us now for more, our own Taylor Riggs. Taylor.
Yeah, Lisa, and you're right that Friday we started to build up some of the momentum. Even though Friday was a relatively good day, it was still sort of wrapping up a week of losses, as you mentioned, coming off Wednesday's meeting. So trying to at least today build on some of that, a little bit of the momentum that we had as of Friday. You're certainly seeing technology participate. A lot of people saying you really need that as some of the heavyweights in the index to participate. You're seeing that with Apple, of course, some positive news on the iPhone sales. The stocks index last week was off about 9%. So you're starting to see some of the chip makers come back today. Certainly good news. I have to talk about Bitcoin. We know that it doesn't stop trading over the weekend. It did briefly dip below 18,000. You're starting to get a little bit of that comeback. So, right, blockchain, of course, participating in that just a little bit. I think what's interesting, and Romain hates when I do this on the close, I take a look at the equal weight index. He knows that things are really bad when I start to do that. But we've broken out the tech versus the non-tech in the equal weight. And you are starting to see some of those non-tech roll over as well. And that might actually be a sign of some of a broad-based decline, some of that full capitulation that a lot of people are looking forward to seeing before you can get a true bottoming out. So perhaps maybe actually a good sign that some of those non-tech heavyweights are also really starting to roll over as well. Maybe a bigger buying opportunity ahead. Finally, here you can see, just sort of recapping the big action on Friday, Lisa, is that tech was starting to rebound, right? But energy was really to the downside. Now, today, of course, we know everything's sort of a broad-based rally, maybe some signs that if this will stick into the closing bell, that a lot can happen between now and 4 p.m.
Taylor Riggs, thank you so much. Isn't that the truth? Sticking with big tech, Tesla CEO Elon Musk speaking with Bloomberg at the Qatar Economic Forum. Take a listen.
A year from now, I think our headcount will be higher in both salaried and obviously in hourly. But in the short term of the next few months, we expect to see, like I said, roughly a 10% reduction in salaried workforce, which is actually just really only a 3.5% reduction in total headcount, and not super material.
A sober and really kind of restrained Elon Musk. Ed Ludlow joining us now from San Francisco with more. Ed.
Yeah, good morning, Lisa. I mean, with his Tesla CEO Holt clarifying comments that he made in internal memos, he basically said that salaried headcount grew too fast, but he gave a really good picture, robust picture of demand for Tesla, saying that wait times are very long, demand, quote, remains extremely high, and you see Tesla stock pushing higher 5% this Tuesday morning. A really wide-ranging interview with the macro backdrop, Musk saying that a recession is inevitable at some point, in his opinion. Whether a recession or not happens in the near term, he said, is more likely than not. The other big topic, of course, was his deal to buy Twitter at $54.20 a share. He says there's, quote, still a few unresolved matters. The proportion of users on the platform that are bots, whether they are less than 5%, as Twitter says, being the main sticking point. He's awaiting further details and clarification on that. Although what was really interesting is, once again, with such a forum, such an opportunity, he did not explicitly state that he intends to proceed with the bid, $54.20 a share, although Twitter shares also higher by around 1% on Tuesday morning.
Ed Ludlow, thank you so much. Morgan Stanley with also a pretty sobering view, saying that U.S. stocks need to fall even further despite this year's slump. Mike Wilson saying the current market, quote, does not price the risk of a recession, which is 15 to 20% lower, or roughly 3,000. The bear market will not be over until recession arrives, so the risk of one is extinguished. Kaylee Lyons joining us now for more. Kaylee.
Well, Lisa, apparently a 23% drop in the S&P 500 so far this year, and June isn't even over, is not enough to accurately price in the growth risks that this country and this market are facing. That's the thesis from Mike Wilson over at Morgan Stanley, who says stocks could drop another more than 700 points in the near term. And he's not alone in that. Goldman Sachs, Peter Oppenheimer over there, also said that only a mild recession is priced in at this point, which leaves the market vulnerable to a deterioration and expectations. All that said, Goldman still has a 4,300 target on the S&P 500 at year end. Morgan Stanley, Mike Wilson, has a 12-month target, so a little bit different, but he sees it at around 3,900. But Lisa, just look at where consensus is, 4617 on the index. That would imply about a 22% gain for the S&P 500. And you have the likes of John Stoltz over at Oppenheimer with a 5330 target, which would require a 45% rally over the next 6 months. So the gap in the range within forecasts is huge. Obviously, a lot of it ultimately will likely come down to the earnings story. Right now, second quarter earnings expectations are only for about 4.2% growth in profits, widening back out in the back half of the year, but still below those COVID peak levels. And Bloomberg Intelligence points out that you are seeing forecast revisions trending downward for the S&P 500 for each quarter until 2023, Lisa.
Kayleigh Lyons, thank you so much. Goldman Sachs also seeing U.S. stocks exposed to more downside risks, saying, quote, while there has been a considerably derating and some markets are trading below average valuations, pricing is more consistent with a mild recession than an average or deep recession, leaving them exposed to a further deterioration in expectations. Kayleigh, as you were talking about earlier, joining us now, Invesco's Kevin Holt alongside Julie Biel of Kayne, Anderson, Rudnick, who is still with us. This has been an issue right now as we deal with the potential for recession. At what point, Julie, do you actually see the market pricing that in? Or do you have a price point for the S&P?
We don't have a price point for the S&P, but we're paying a lot of attention to valuation metrics, right? And in a true, proper, deep recession, we should be in single-digit forward earnings multiples, and we're not there yet. And I think too, it's understanding the strength and durability of the earnings within the S&P. You have some sectors that are very exposed to major earnings declines, your deep cyclicals and your deep value cyclicals, which have seen a really strong rally in the market. So I think there are major pockets of exposure where you could see big declines going further. So I think it really pays to be very choosy. I think it's a great time for active management because a lot of the market movements have been broad brushstrokes. So you can really find some good businesses here.
Kevin, are people too pessimistic right now?
I don't think so. I think you have, the Fed increasing rates for the first time in a long time. You have the end of quantitative easing. And multiples are about, if you believe the earnings of the market right now, about 15.5 times earnings. So I kind of think with our first rate increase just behind us, I think it's going to be a tough summer. And I think rates are going to continue to move higher throughout the year. I think we're likely to have earnings disappointments in Q2, which are going to create more attractive entry points probably later in the year, either Q3 or Q4.
So where's the value right now?
Well, and I think it's kind of interesting. It's most of us haven't lived through an inflationary environment, and I don't think the 70s are really even indicative of what we're at, because the 70s was mainly oil. So you have to go back to the late 1940s to where we have pervasive inflation, not only in oil but in food and a number of different areas. So I do think we're in an inflationary cycle. Personally, I think it's going to be here for a sustained period. I think wage inflation is something that will probably be around for a few years. Some of the other issues, oil, I think, we've restrained supply. This is not the same oil industry we've had. Demand is going to go down in a recession, but oil prices, like we had in 2020 or even, the $50 level we've had historically, I don't think is going to happen again in the near future because this is a much better run industry than it's been in the past.
This sounds like a pretty pessimistic recipe, and every guest that we've had on this morning has had a pretty negative view in terms of where we could potentially be traveling. But Julie, other people point to the fact that you're actually getting yield for the first time, actual real yield, and 8.5% coupons on certain junk bonds on average. At what point do you start to ratchet up returns expectations because of the increased risk?
Well, I think it just depends where you're looking within the risk tolerance and risk appetite. So, I think because it's been broad brushstrokes in terms of what's sold off, particularly, let's say, in the tech sector, not all tech businesses are the same. There are ones that have, slower growing but very durable earnings that are well protected, even in a recession. You look at a business like Aspen Technology, which even in the glut of oil prices was still delivering solid earnings growth. Those are the types of businesses that I think really can help you weather through the storm and also allow you to participate in the upside when we get to a recovery. So if you're a slow moving investor like us and you just want to know your businesses really well, those are the types of businesses we're looking at right now.
Meanwhile, Taylor basically pointing out how much big tech has sold off, and bull's gonna bull. Wedbush's Dan Ives still being bullish despite the recent volatility in big tech, writing, quote, the street is already baking in a mild recession into current tech stocks, and the risk-reward setup is favorable for our top enterprise plays. We could make any argument under the sun, but Kevin, do you think that there is a bottom starting to come in here, given the cash flows and given how much these really do have incredible market share?
Yeah, and I think what we've seen throughout the year is, the first group that was shot was technology, and then financials, and then retail's had its issues. So I do think there's opportunities in tech. I do think a number of the stocks, much like 1999, that don't generate cash flow and don't generate returns on capital are not good investments. But I do think, and we've even added recently to some large cap tech names that have strong free cash flow yields, higher than the market, great businesses, great moats. And I do think those type of businesses are going to be what you want to add in this tough period. And we're going to come out the other side of this eventually. And I do think there's going to be some great values being created, just like there is at this point. You just have to be very selective and very patient.
Yeah, and that's actually something that UBS Stuart Kaiser noted as well in a note, basically saying it feels far away this week, but better second half outcomes remain possible. Talking about for tech upside, we still see a tradable window as core inflation settles into a lower month-over-month run rate over the summer. Do you agree, Julie, that does seem like a likely trading period? I know you're not into trading, but do you think that there might be an entry point, maybe, is the way to phrase it?
Yeah, I think entry points are always something we're looking at, right? For us as longer term investors, the declines that we've seen have actually been a nice breather. And it's sort of like a cleansing shower on these valuations, because we had just gotten to a place that were completely unsustainable. What I would say about tech is that even good quality tech, you have to be a little bit choosy. And so do I want a lot of exposure to the US consumer, or let's say the ad market, which I don't think is nearly as strong going forward as it has been? Not really, no. Even though these are really powerful businesses in terms of their duopolies, monopolies, I still think I would rather choose a software business that's serving other enterprises or other business communities. I think they'll be more resilient than anything that's tied to the U.S. consumer.
Julie, thank you so much for being with us. Kevin Holt, we're sticking together for another at least 20 minutes, so sorry. Coming up, recession risks rising. Take a listen.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
That conversation's still ahead, and some people did not get the pessimistic tone, at least if you take a look at where stocks are trading, up more than 2% in the first 15 minutes of the open as people look to claw back some of the losses experienced last week. This is Bloomberg.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
Homebuilders keeping a close eye on surging mortgage rates. Lennar Chairman Stuart Miller saying, quote, the weight of a rapid doubling of interest rates together with price appreciation began to drive buyers in many markets to pause and reconsider. We began to see these effects after the end of the quarter. Bloomberg's Michael McKee and Taylor Riggs both joining us for the data to watch this week and the broader market ahead. Michael, what are you looking at?
Well, let's take a look at the impact of those higher rates. Bankrate already has the 30-year fixed mortgage average for the country at over 6%, that coming in this morning. But it's not the 10-year note that necessarily drives it. You got to look at the Fannie and Freddie commitment rates. 5.46 is what they will buy a mortgage at, and that's what's key to you getting a mortgage. And you can see the impact on the white lines in the background. That's existing home sales. And when rates go up, sales go down. That's what's happening. This week, we get a number of numbers, including existing home sales at 10 o'clock today. They're expected to be down 3.7%, continuing their run lower. Mortgage applications on Wednesday, they popped up just a little bit, but not much. They've been going down as people pull out of the market. And then Friday, new home sales, they're expected to be marginally higher. But again, this is a declining market because it's the most interest rate sensitive. Now, the other thing that Lennar and the other home builders are worried about is what prices are. Do they price people out? Look at the solid lines. That's existing in new home sales going down. That's what's been happening. But look at the dotted lines. Those are the prices for existing home sales and for new homes, the median prices. They still keep going up, and that's what's feeding into inflation. Those have to turn around. The solid lines have to pull the dotted lines down in order for housing to stop contributing to the big inflation inflation rise we've got.
Yeah, well, and Taylor, this goes to the home builders and the outlook for them at a time when there still is a lot of demand.
Spot on. I'm taking a little bit of a play out of Mike's playbook. Take a look at this terminal chart. I think Mike said it best, right? When rates go up, prices go down, new home sales go down, existing home sales go down, right? So that is the classic correlation here that we're looking at. Mike McKee knows this better than I do, but arguably maybe this is actually what the Fed wants, right? Trying to cool off maybe a little bit of an overheated market here. And so that is the basic supply and demand dynamics here at work. Take a look at year to date, some of the price action here of what's been happening to some of these home builders. Really tough, right? As some of the sentiment has rolled over on the fact that prices have been rising. We've talked a lot about the lack of inventory, some of the lack of affordability underway. You're off anywhere from like 42 to 44% year to date. So well into correction, well into bear market territory for some of these individual stocks. I liked Lennar, of course, because they're coming out getting a little bit of a bounce today and saying that, well, maybe this is a bellwether for the group. Maybe things aren't as bad as we think about sentiment, and finally being able to come back into that stock. Here's a good key here, though, Lisa. Mike has been talking a lot about the rising costs, the rising input costs. Lumber is coming down a little bit, and so what that means is, well, maybe some of the home furnishings are also coming down as maybe people aren't having to furnish some of those homes. But that could be good news when some of that high input costs like lumber are starting to roll over just a little bit.
Taylor, Mike, thank you both so much. Invesco's Kevin Holt still with us. Kevin, do you start to see opportunities when you see home builders beaten down to that degree and the fact that people still want to buy homes?
Yeah, I do think what's difficult right now from a stock perspective is we're fighting the fear of the unknown. And as I said, we just increased rates for the first time. So I think economic activity is going to slow, and it's going to slow probably over the next 3 to 4 quarters. So I think it's, ultimately valuation and risk return, but I think it's still too early. I think the housing market's been incredibly strong for a long period of time. And I think with some of these cyclical stocks, you have to be very choosy about what industries and how much demand elasticity there's going to be. And I think in housing, with rates going up like it has, I think housing is going to be in for a tough run for a bit.
Over the past decade, though, Kevin, a lot of the emphasis has been for shareholders, for some of these home builders to return capital, to be prudent, to not really develop as much as be profit generators. At what point does that become an attractive proposition at a time when you still have a dearth of homes relative to demand, at least according to many housing experts?
Yeah, and I think it's just going to be, the big thing to focus on right now is just how demand holds in there, because you're exactly right. It's a much better industry than it had been in the past. It doesn't have the boom bust cycles quite as much as it's had in the past, although it is, ultimately the demand of the consumer. And interest rates are, at 40-year highs in terms of housing affordability. So I do think we need to be cautious, but it is a good industry, and there'll be a time to own these stocks. The question is it in 2022, or is it more? We need to wait for the economy to kind of weaken. In 2023, we can build positions here.
Kevin, before we let you go, I do want to get your take just quickly here on what kinds of margin pressures you expect. Kevin, do you think that that's priced in, or do you think that that's going to be a real pressure over the next 6 months for equities?
I think it's going to be a real pressure. I think some of the food inflation that we're seeing with the war, Russia and Ukraine, they're going to see increasingly pressure on food prices as we get into the back half. I think oil prices, hopefully, I'm not sure they'll go much higher. I don't think they're going a lot lower in the near term, but hopefully those don't get a lot worse. But then you have wage inflation, which I mentioned, and we see continued pressure on wage inflation, and we still continue to have supply chain issues. As long as China has a zero tolerance policy with COVID, supply chain issues are going to be persistent. So the combination of those factors makes it very tough for the rest of 2022. But I do hope as we get in 23 and lap some of these issues, that creates opportunity, and then the markets can rebound.
Kevin Holt, thank you so much for being with us this morning. Coming up, the market-moving events that you need to be watching. That's next in our trading diary as we try to claw back some of the losses from last week, up more than 2% just into the open. This is Bloomberg. Bloomberg's The Open. I'm Lisa Abramowicz in for Jonathan Farrow. Just taking a quick look at markets, you can see the NASDAQ really leading the way, up 2.6% as people perhaps try to find value after last week's 6% loss. It's time now for the trading diary, what you need to be watching this week. Existing home sales coming at the top of the hour, followed by Fed speak from Barkin and Mester. On Wednesday, Chair Powell heading to Capitol Hill for 2 days of testimony. Plus, we'll also hear from the Fed's Evans and Harker. Another round of jobless claims and the Fed releasing the results from its stress test on Thursday. And finally, new home sales, Michigan's consumer sentiment survey, the key one for the Fed, at least according to them. And the Fed's Bullard and Daly speak on Friday. This was Countdown to the Open from New York. This is Bloomberg.